This might be the last great wealth creation opportunity that many of us see for a long time. And I want to do this video because there's an underlying theme that the stock market is dramatically overvalued and there's only one way for it to go, and that's down. And that might be the case, but it might not. So in today's video, I want to share with you what I see the opportunity as and why you might want to think about value in a longer term scope. So of course, the opportunity that I'm talking about is created by artificial intelligence. That is all the rage right now. And I don't want to talk about specific companies. I don't want to talk about chip manufacturers. I don't want to talk about people that are building specific tools. But I do want to talk about artificial intelligence's impact for everyday American businesses, Main Street businesses, and really around the world. And for most companies, labor is one of the biggest expenses. And artificial intelligence is offering all of us a chance to do things better, faster, and cheaper than ever before. So while by traditional measures, if the stock market certainly does not look inexpensive. One of my favorite indicators is called the Buffett indicator, and that is the value of all the stocks in the country divided by that country's gross domestic product. And right now, that valuation measure is 2 standard deviations above normal. The other one that I like to look for is an academic one that was put together by Professor Robert Shiller that looks at a 10-year average price to earnings ratio. And a price to earnings ratio is just looking at how much people are willing to pay for $1 of earnings from a company. And so it's called the Shiller ratio. And that ratio is also 2 standard deviations above normal. So yes, I completely agree that the stock market does not look inexpensive. However, there are times where, because of the earnings capacity of companies and potentially a seismic change in their cost structure, where valuations are going to get out of whack. There is a reason why companies that are growing quickly and is growing their earnings very quickly, those companies will trade at a higher ratio. So my question to you is, what if Main Street American businesses look like that? What if they're going to be able to cut their labor costs by 20%, 30%, 40% or more? That is significant. Now, really important, I hope you're still staying with me to this point here. People that get hurt are the ones that go all in. They're also the ones that get rich if they're right. But for most of us, avoiding mistakes is much more important than making the right call. If we can stay in over a long period of time and let our investments work for us, particularly our asset allocation, if we can get that right, over time, we're likely going to do okay. So the purpose of this video is just to push back on the narrative that I'm hearing on a daily basis, which is the stock market's overvalued. And my reply to that is maybe. Maybe it is. But you know what? Maybe it's not. I am at this event right now. It's called Future Proof. It's an event for financial advisors. And I can tell you that there's a beautiful setting, right? This is Huntington Beach, which Newport Beach is more famous, but Southern California, beautiful setting here. But I can share with you, there's 2 main themes right now at this conference, and that is how artificial intelligence is going to allow financial advisor firms to do better, to do their work better, faster, cheaper, which is great. And I also think there's another theme that's not being talked about enough here, which is there are going to be tools that average everyday Americans will be able to use to create their own financial plans. And I want to talk about that for a second, because I think the gold standard is always going to be to work with a financial advisor. Now, that's not inexpensive. And many people in my audience says, hey, Azul, I've spent 20, 30, 40 years building up my net worth, and I don't want to hand that over to somebody. And I get that. And if that's you, what I would say is take advantage of the tools that are out there to build your own financial plan. Right now, the best software I think out there is a tool called Bolden, used to be called New Retirement. There's a link in the description below. I am an affiliate for Bolden. So if you use the link in the description, you'll be supporting the channel. And I do think companies like Bolden and others are going to begin to have better software for all of us, where it'll be easier for us to create our own plans, and we'll get higher quality plans, frankly, with less work. So let's go back to this opportunity that artificial intelligence offers. Now, one of the things it's done is a lot of companies now, there's what I call there's a fair amount of perfection already in their numbers, priced into their numbers. So the current stock price, I think for many companies, reflects that they're going to win. And maybe they win and maybe they do not. But there are companies that, I used to live in a ski town, and the term I use is they've gotten ahead of their skis. Now, it may pan out really well, and the winners in this space are, I think, going to do really, really well. But it remains to be seen who the winners in this space are going to be. So I'd be careful making specific calls on who's going to win and who's going to lose. But I do think you want to give yourself some exposure to these companies. And for many people, that's going to be through a broad index, maybe an exchange-traded fund. And going back to that idea of your asset allocation, not enough people are thinking about this. What percent of your portfolio is in stocks? What percent is in bonds? And just be ready in case something like the dot-com bubble happens, in case something like the great financial crisis happens, so that you've got the right asset allocation so you can weather the storm. I think getting that asset allocation right is the most important. Multiple studies have shown that 90% of your success as an investor is going to be tied into that. Again, gold standard is to work with a financial advisor. If you're not going to do that, use software that's designed to help you do scenario analysis. Again, Bolden, your description in the link is the software that I like for that. But be ready to stay the course, and don't get overly optimistic. Don't get overly greedy. And also don't get overly cautious. One final thing, in case of the general narrative that the financial market is overvalued, in case that comes out to be true, for me, this is not financial advice, nothing, but for me personally, I like to keep 5 to 10% of my portfolio in cash. So if the stock market does go down 20, 30, 40%, at least mentally I can think I can benefit from this. I can buy stocks at a low price. I have cash. The problem is if, all your money's invested, if your account's down, you've got to sell something that's down to buy something that's down. I personally like to have a little bit of cash just to help give me the mental fortitude to stay the course. The other thing that I think is important to think about, how many years worth of living do you have in high quality, short duration bonds? Many people will say, hey, Azul, 60% stocks, 40% bonds. That's great. Whatever the number is, 70, 30, 50, 50. But I want you to also think of your bonds as how many years worth of living expenses do I have in bonds where I don't have to touch my stocks if they're down. And I do want to thank the folks at the Future Proof Conference for inviting me to this conference at this beautiful place here. It's been great being here. I hope I get invited back next year. And thanks for watching this video. If you enjoyed this one, I think the next one that you'll enjoy watching is this one here, which talks about another really important decision, which is the decision on when to retire and why waiting to 65 to retire might be a big mistake. I'll see you in that one. Bye-bye.